Good morning, marketeers. Let's talk money. Charles Schwab just dropped their latest stock sector outlook, giving us a deep dive into where the market might be heading in the next 6 to 12 months. While they didn't change any of their sector ratings this time around, there's a lot of movement beneath the surface worth paying attention to. Let's break it down. Schwab is sticking with its outperform rating for two sectors, financials and communication services. These areas are expected to lead the pack, backed by strong fundamentals and growing momentum. On the flip side, consumer discretionary remains in the underperform zone, largely because of Tesla's recent slump. Since Tesla holds a heavy weight in that sector, its losses are dragging the whole group down. So why are financials and communications still strong? According to Schwab's model, sectors with positive earnings trends, reasonable valuations, and solid price momentum continue to get the green light. Financials are benefiting from improved net interest margins and a stabilizing rate environment. Communication services is riding high on performance from tech-adjacent giants like Alphabet and Meta, both of which saw massive gains in recent months. Now here's what's interesting. While Schwab's model used to favor value over growth, that trend is starting to reverse. Growth is climbing back into favor, and sectors with a stronger growth tilt are now seeing better scores. This could signal a broader rotation in investor sentiment as rate cut expectations grow stronger and inflation concerns slowly ease. But it's not all roses. Energy and utilities are still rated as underperform. Despite energy prices rising earlier this year, Schwab points out that volatility in oil and geopolitical risks continue to make the sector unpredictable. Utilities, often considered a defensive play, are still facing pressure from high debt loads and rising operational costs. Healthcare and information technology both fall into the market perform category. Healthcare has the potential to outperform if economic uncertainty drags on, given its defensive characteristics. Meanwhile, tech has cooled off from its 2023 rally. Still, Schwab says the long-term fundamentals remain solid, especially in areas like AI and cloud infrastructure. Another key point? The model includes four major factors: macro, fundamental, valuation, and momentum. Each of these contributes to Schwab's sector ratings and outlooks. What's notable this month is that the momentum factor carried more weight. That means sectors with stronger recent price performance saw score improvements even if fundamentals lagged a bit. Consumer staples and real estate also sit in the market perform middle. Real estate is still adjusting to elevated interest rates and tighter lending standards, while staples remains a go-to during volatile periods but hasn't shown major upside potential. If you're looking for stability, industrials and materials are steady but unspectacular. Schwab notes that slowing global demand, particularly in manufacturing and construction, continues to weigh on these sectors. Still, their overall balance sheets and earnings remain relatively stable. So what does all this mean for your portfolio? In short, Schwab's playbook is calling for a balanced approach. Keep your eye on communication services and financials for outperformance. Be cautious with consumer discretionary and energy. And stay alert as growth continues to edge back into the spotlight. This is not financial advice, but it is the kind of data-driven insight that long-term investors can use to stay informed and aligned with market trends. If you want to read the full Schwab sector outlook, you can check it out in the comments below. See you next time, and stay smart out there.